team and I will be using SVB as a financial case study to highlight why the bank collapsed, contributing factors, the broader impact of the bank's collapse, and some lessons to be learned. Several critical factors contributed to SVB's collapse. Firstly, the bank lacked diversification. SVB had a large exposure to the tech industry, so when the industry was hit hard by the economic downturn, SVB faced substantial losses. The bank was also an aggressive lender, lending money even to startups that were not creditworthy, which made it more vulnerable to losses when the market crashed. Thirdly, the news of SVB's financial problems triggered a run on the bank, resulting in a liquidity crisis, where SVB did not have enough cash on hand to meet its obligations. Finally, SVB's poor risk management practices made things worse. The bank did not properly assess the creditworthiness of its borrowers and lacked adequate reserves to recover its losses when borrowers defaulted on their loans. These shortcomings made SVB more susceptible to the adverse effects of the market crash. The bank's collapse was significantly influenced by its exposure to the financial market. The collapse was a perfect storm of events. The industry crash, rise in interest rates, and SVB's own poor risk management practices came together to cause the bank's collapse. The lack of diversification in its lending portfolio made SVB more susceptible to market crash when tech startups were unable to repay their loans during the economic downturn. SVB also heavily invested in long-dated US government bonds. So the sharp rise in interest rates in 2023 led to a decline in the value of these bonds, causing SVB to suffer even more losses. Finally, the bank's poor risk management practices made things worse, as mentioned earlier. Leverage allows an investor to control a larger asset with less capital by using borrowed money. This means that a small change in the value of assets can lead to a large change in the value of equity. SVB's high level of leverage contributed to its collapse in the following ways. Firstly, it magnified losses. The loss of a small number of loans due to the economic downturn led to a large loss of equity, which forced the bank to close its doors. It also made it difficult to raise capital. When SVB's stock price fell, it could no longer raise capital since investors were less willing to invest in a bank that was losing money and had a high level of leverage. As a result, SVB was unable to raise the capital it needed to stay afloat. Finally, it made it difficult to manage risk. Because a small change in the value of assets can lead to a large change in the value of equity, it makes it difficult for the bank to predict how much it will lose in the event of a financial crisis. Now, Lai will discuss the significance of liquidity in the context of SVB.
Thanks, Kim. Let's discuss the significance of liquidity in the context of SVB collapse. In the context of a bank, liquidity is important because it allows the bank to meet its obligation to its depositors and other creditors. SVB had heavy exposure to long-term securities and bonds. In 2022, when interest rate increased, these securities and bond value falls. This has caused liquidity issue for SVB when tech startups were hit by poor economic performance. They started to withdraw cash to meet their liquidity needs, thus affecting the bank's deposit. When news of SVB liquidity problems spread, a bank run ensued. Next, let's examine the decline in market confidence and its impact on SVB. Market confidence is key in preventing a bank run. After the announcement of SVB, investment loss of about 1.8 million from the sale of investment, including bonds and security, has set a panic attack among its customers, and a bank run ensued. SVB stock plummeted by more than 60% in days leading to SVB collapse, thus making it more difficult for SVB to raise capital. During the collapse of SVB, some regulatory challenges emerged that contributed to the bank's failure. One of the primary regulatory challenges was regulators failed to follow up on SVB increased exposure to long-term securities and its potential impact on liquidity. Although regulators noticed some rate flags sometime before the collapse of SVB, SVB reliance on short-term funding made it vulnerable to the liquidity shocks, and the regulatory framework at the time did not adequately address the risks associated with short-term funding. The lack of timely and transparent communication from regulatory authorities about the bank's financial health and measures to address the liquidity crisis contributed to the loss of market confidence. And we have identified 4 regulatory framework shortcomings. Firstly, the regulatory framework lacked effective resolution authority and bail-in mechanisms, helped in failure of large banks like SVB to make uninsured depositors whole without losing taxpayer money, exacerbated the crisis. Secondly, the regulatory framework did not adequately protect depositors from losses exceeding the maximum insured amount, leaving a significant portion of depositors exposed to potential losses. Thirdly, the regulatory framework did not have robust market monitoring and early warning systems to detect early signs of financial distress in banks. Enhanced surveillance and early warning mechanism could have enabled regulators to intervene before the crisis escalated. Lastly, the shortcoming in the regulatory framework also highlighted weaknesses in SVB risk management practices. SVB inadequate consideration of liquidity risk contributed to its vulnerability during the crisis. I will now hand over to Edward to discuss the broader impact of SVB collapse.
Thank you, Lai. Now let's talk about the broader impact of SVB collapse, particularly on financial institutions. Firstly, the collapse actually resulted in a loss of confidence amongst investors and clients. This creates a bleak or negative global outlook and raises high level of concerns on the safety and security for customers and investors. This ultimately results in an increased possibility of bank runs and withdrawal from other financial institutions. Now, one major impact is the economic repercussions, where the collapse heavily affected the global stock exchange. One of such affected exchange would be the S&P 500, where the S&P 500 index decreased by 10% the following day the announcement was made. This effect actually spiraled across, where the economic uncertainty cautions on the lower consumer spending and investment activities, thus resulting in the global economic slowdown. Another impact will be the stricter lending standards, where the financial institution implemented stricter borrowing criteria, especially to businesses that have similar business model or risk profile to SVB. Such criteria will include higher interest rate, regulations, and compliance standards, making borrowing significantly harder and more expensive for business. This will in turn affect business operations and bottom line profitability. Lastly, market consolidation may take place, where bigger financial institutions may take advantage of the situation to acquire assets and their customer base, thus leading to increased competition, potential exit of smaller banks, and merger and acquisition. One of the key examples of such instance will be the acquisition of Credit Suisse by UBS. Now, what could have been done differently to prevent or mitigate the collapse of SVB? Firstly, comprehensive risk management framework should have been implemented to identify, assess, and monitor various risks such as credit risk, market risk, liquidity, and or operational risk. Aside from this, regular stress testing and scenario analysis, early warning system, and contingency planning should have been in place to identify emerging risks and take actions upon them. SVB should have been more practical in terms of their lending practices and their due diligence, as SVB lending approach was too aggressive. SVB should have conducted in-depth assessment of its borrowers' financial health, business model, and repayment capacity to avoid excessive exposure to risk, and also implement stricter underwriting standards and adhere to conservative lending practices. Now, SVB should have done a better governance and oversight in terms of SVB operations and risk management, where one of the direct causes of SVB collapse was the inadequate supervision and poor governance for its board of directors and bank management, where many of the board members had a vested interest towards making decisions that benefit the shareholders the most and were not qualified to actually oversee the entire bank operation management. As such, SVB should have implemented an independent board of directors that represent all of the stakeholders' interests, include members with experience and expertise in the financial services industry, formal processing for evaluating the bank management performance, and hire external experts and advisors for the bank management's performance and risk management. Lastly, SVB, well known for catering towards technology startups and innovation-driven company, should have diversified its portfolio across different industries to actually spread its risk. Now, let me pass on the time to Eunice to talk about the lesson learned.
Thank you, Edwin. The first lesson that we learned is the importance of risk management in financial institutions. So to avoid such scenarios from happening in the future, regulators should emphasize on continuous risk management practices by allocating supervisory resources to stay ahead of emerging risks and ensure compliance with regulatory guidelines. So secondly, it is enhancing liquidity management. So to mitigate this risk, financial institutions should maintain sufficient liquidity buffers and establish contingency plans and effective communication strategies to manage potential liquidity crises in future. So moving on, to address this, regulators should periodically review and assess the adequacy of deposit insurance limits, and as well as educating the public about the deposit insurance coverage, as well as their rights and responsibilities. So next, we'll move on to explore the ethical consideration and implication for financial institutions as well as their stakeholders. So first and foremost, it will be regarding transparency and risk management. So in SVB case, there is a need for accurate disclosure of risk exposure and transparency in financial conditions, because this ensures that stakeholders are able to make informed decisions, and it also ensures accountability. Secondly, responsible risk management practices are essential in mitigating potential risks, as SVB's conduct of due diligence is cast into spotlight. Lastly, it will be the fiduciary duty of financial institutions, as that is a crucial ethical consideration. SVB should have aligned their investment decision with the objective and risk tolerance of their stakeholders, and this duty extends beyond safeguarding their funds and ensuring institutions' overall stability and soundness. In conclusion, the lessons learned from SVB case has far-reaching implications for both financial institutions as well as their regulators. By implementing the mitigation strategies that has been shared by my group earlier, we hope to prevent similar events from happening and create a more transparent and robust financial ecosystem for all. Thank you.